All right, everything looking good. We are live. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on August 14th, 2022. And before we get started, as always, I'd like you to remember this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Okay, so got a big week coming up here. Honestly, probably just going to be like one big week after another for the next few weeks because we're at some key levels. And whatever happens over the next few weeks is going to basically determine where we're headed from here on pretty much all asset classes. So let's take a look at our, well, before we get started today, I think I'm going to change up the way we do the streams just a little bit. Rather than just looking at every asset, every stream like we normally do, I've talked about like breaking it down into like different days, different stuff, whatever. I'm not sure exactly how I'm going to do it or how I'm going to structure it or whatever, but I'm really going to shoot to and try to stick to like 1 to 2 hour streams because I just don't think it's viable for most people to dedicate, 3 or 4 hours 3 times a week to listening to these streams. So what I'm going to do is cut down the length of the stream some and then put out more static videos and just do that for a while and see how that works. Because the streams are great, but they don't really do anything to like build the channel. And obviously the whole reason I started this channel was to like help people and build it up and grow it. So while the live streams are phenomenal, I think doing shorter live streams and then having more static videos is more beneficial. So I think we're going to go that route into the future. So I'm basically going to have like a hard stop around 2 hours for all the streams. And if we don't make it to something, we don't make it to it. But that way I'll look at certain assets on certain days. Like there's not a big reason to look at like Friday to look at traditional markets and then look at them again on Sundays because there's only a couple hours between when the stream ends on Friday and the market closes, and then nothing really happens over the weekend, and then we go back and look at them again. So there's like a lot of redundancy that I'm going to eliminate. Also going to try to like stay a little more on track. I'll still talk about like some of the topics and everything, but going to try to cut down like the length and frequency of some of the I don't know what you want to call them, like rants or just like whatever it is. So all right, so that being said, let's take a look. TNX on the daily, we are back above the 8 and 21. Looks very likely we're going to get that cross to the upside. So at this point in time, just holding on to the 2.8 level is going to give us a bull cross and continuation of upside. Still very, very bullish. Hard buy signal, all green histograms. Rates are going up as expected. U.S. oil is next. We talked quite a bit about this lately. Obviously, we're trading sideways inside the channel, and then we started to form this descending channel right here. So now that we are basically in this white channel right here, I placed a potential trade setup right here. Essentially, if we just go sideways right now at the same level, we will have broken out of the descending channel. And if we break out of the descending channel, our measure moves should take us back up to like roughly around like the heart line, something like that, around 104, with potential that we would come all the way back up to the top of the range and put in another lower high, somewhere closer to like, 115 or 118. We're talking about 25% move in oil with a 5% stop loss. Giving us essentially a almost 5-to-1 risk reward ratio. Hard buy signal leaving the bearish control zone, a bunch of green histograms. Do I think oil is just going to shoot up to the upside and go to new highs? Not necessarily. Do I think oil is going to like break down from here and just get absolutely wrecked? Again, I got to say not necessarily. It seems more likely than not after this consolidation and this breakdown from the pattern that we're either going to backtest, it's going to fail and roll over, in which case we'll never have entered this trade because we won't have actually like broken out of the channel. It'll basically just continue trading inside the channel and just keep going lower. Or we're going to get like the sideways action, breakout, whatever, and then we'll have, 25%. So that's what I'm looking at for oil. All right, so on to our stocks now. So we obviously had targeted this area on all of our major indices. A back test of the 200 exponential and 200 simple. And at this point in time, we made it to our, maybe I just deleted everything. So regardless, we don't need any drawing tools or anything. We made it to our target. We're there. So at this point in time, we have a high, a low, a lower high, a lower low, and now we're coming up here and we're basically just putting in another lower high. So unless we come all the way up to 354, unless we start closing back on top of the 200 exponential and 200 simple long enough that they both switch blue, it looks to me like this is it. The move is basically already played out as expected. I mean, this was the move we were talking about. This was the move we were expecting. We played the move, and now we're at targets where we're taking profits. We don't have to just dump all of our positions at once. But I think at this point in time, we have to be responsible and just assume that this move has or is very, very close to topping out. So we have a hard sell signal. We're still inside the bullish control zone, still green histograms, blue slope line, powerfully, and go to the upside. 200 exponential is flipped over bullish. We're very close to backtesting 200 simple. But to tell you the truth, that's what we do on every backtest. Here we break above the 200 exponential, it flips blue. Break above the 200 simple, it flips blue. Roll back over, test it, push back up, and then it fails and just rolls over. So is that happening again? Probably. Is there a possibility we consolidate back on top of here and then we're headed up to retest this level and then all-time highs? 100%, definitely a possibility. But as far as I'm concerned right now, nothing has changed for me. We haven't confirmed back into a bull market. We're still very much in a bear market. The only difference is we got the reversion to the mean. The play has played out, and now here we are, basically ready for the next move, which is likely going to be to the downside after such a powerful move to the upside. All right, so SPY is next. S&P 500, again, almost the exact same chart. We're in the bullish control zone, a bunch of green histograms, blue slope line. 821 have crossed bullishly back to the upside. We're back on top of the 200 exponential, getting ready to touch the 200 simple. And again, at this point in time, we just have a series of lower highs and lower lows. High, low, lower high, lower low. And then here we have basically another lower high. So until we take out 461, we will not have broken the downtrend. And until we're back on top of $431, we will not have confirmed back into a bull trend. And even then, we need to stay on top for a while, flip the slope back blue, and then we can start, really working this. And again, we saw a similar scenario here, and then it rolled over and just fell out of bed. So it seems like it's going to happen again. Next, we have the Qs, triple Q, basically just the Nasdaq. So again, high, low, lower high, lower low. Backtesting the 200 exponential. 200 simple still slightly above our heads. Likely going to flip the 200 exponential bullish again. Do we make it a little bit above that? Possibly. Until we start getting back above like 343, we can't confirm back into a bull trend. And until we take out 371, we can't confirm that we're no longer in a downtrend. So again, very much just doing what we expected. And then we have the IWM, Russell. 2000 ETF. So basically, again, high, low, lower high, lower low. We're coming up here, threatening the 200 exponential. We got back up to the 200 simple, hard sell. Still in the bullish control zone, all green histograms, blue slope, telling us, hey, we're going to keep moving to the upside. We're starting to flip this trend back to the upside. But of course, that's always what happens right before the trend rolls back over. So does it have to roll over? No. If we consolidate above 200 long enough, we flip back into a bull trend. Yep. And if we take out this high right here at 211, 212, we take out the downtrend. So those are the next key levels we're watching. Again, nothing has really changed right here. And then for the sectors, basically the exact same thing. XLI has reclaimed above the 200 exponential and simple. So all it has to do is go sideways to flip back into a bull trend. And all it has to do is take out the high at 104 to, basically say we're no longer putting in lower lows and lower highs. The downtrend is over and now we can be bullish again. Now we're saying all this, and I don't want anybody to get the wrong idea thinking now I'm bullish or now I'm more bullish. I was bullish at the bottom while everybody else was bearish, obviously. And now that the move has played out, I'm not going to switch to being bullish until the signs present themselves. But the reason I keep saying it over and over again, those key levels, flipping the 200 exponential and simple back bullish, because those are lines in the sand where regardless of if I believe it or agree with it, where I basically say, okay, well, that's it. The market says we're in a bull trend now. The market could change its mind in the next couple of days, but for now, we're back bullish. And the same thing with lower highs and lower lows, essentially confirming a downtrend. Once we take out a key swing high, we're no longer in a series of lower highs and lower lows, so we're no longer in a downtrend. So XLI, industrial, again, very, very much just doing the exact same thing. XLB, slightly underperforming. Material is basically just now backtesting 200 exponential. 200 simple is a couple dollars higher, a little weaker there. XLF financial sector, again, very similar. Testing the 200 exponential right now. Needs to get back above the 200 simple to start being bullish again. XLY, consumer discretionary, again, very much doing the same thing. XLK, tech sector, all the way back up here at the 200 simple now. Again, consolidating above that level, would likely flip the 200 simple back blue. Then we threaten the 163 level. After that, all-time highs. If all those things happen. XTN, transportation sector, again, doing the exact same thing. No surprises here. XLC, communication, just the absolute dog. Just completely underperforming basically everything in the market. Nowhere near the 200 exponential and simple. As everything else has basically tagged the 200 exponential or 200 simple. And this is very, very important, because if we want to know the strength of an asset or an asset class or an index or whatever, we can look at it in relation to other things. So if you're not above your 200 exponential and simple right now, you're not bullish. So anything above the 200 exponential and simple with blue slope is like one of the better charts. Anything below them is pretty average at this point in time. Anything substantially below them, like this, is absolutely horrendous. And, you know, full spoiler alert, this chart actually, if you were going to compare this chart to something else, what does this look like? What is this absolute dog, this underperformer? What does that remind us of? Bitcoin. Bitcoin is substantially below. Crypto in general, with the exception of Ethereum and a couple other ones, you know, Binance, Matic, they're substantially below their 200 exponential and simple. Absolutely just very, very weak in relation to just about everything else. Doesn't mean there's not opportunity. Doesn't mean that the percentages aren't bigger to the upside and to the downside. It just means the overall posture of crypto in general is really bad. I mean, XLC, communication, is by far the worst sector in the stock market. And this is basically a splitting image of the Bitcoin chart. Not good. XLRE, real estate, has gotten back above the 200 exponential, 200 simple, slightly up above. And obviously we have that swing at 50.85 we'll be paying attention to. It is worth noting that we have a sell. We have a buy inside the bullish control zone. This often leads to a sell by sell, which is a bearish divergence signal. So this definitely has me alarmed that, you know, we might be seeing the first signs of a potential top. So XLP, consumer staples, has reclaimed the 200 exponential. It has reclaimed the 200 simple. Obviously, this is one of our safety sectors. It barely actually confirmed into a bear market very briefly right here, but has overall been holding up very well. And obviously, this was one of the four sectors, the safety sectors we discussed in advance: real estate, consumer staples, utilities, and of course, energy. So utilities next. Utilities is threatening the all-time high. This chart looks absolutely phenomenal. Basically, not many other charts out there right now that are at or close to their all-time highs. So what does that mean? Well, again, utilities are a strong hedge going into an inflationary environment or going into a recessionary environment or slowing economy. So what does this chart tell you? It tells you of all the things out there, of all the assets that people can invest in. You know, your energies, your cryptos, just all the different stuff you could pick. Utilities, one of the best charts right now. So it tells you that if this is a well-known, established hedge for a recession, or, you know, arguably like slowing economy, bear market, stagflation, whatever the situation is, the market, without a doubt, is telling us that they agree with exactly what we've been saying for a long time. That, sure, maybe we're in a technical recession, maybe we don't know yet, maybe we have to wait for, you know, the official numbers to come out, whatever it is, the market agrees. They're trying to protect themselves. And to tell you the truth, if we get above this right here, we're going to new all-time highs, and we still have that trade setup in play to new all-time highs. So XLE looks okay. So we basically were very bullish, bounced the 200 exponential and simple, put in a lower high right here, came back down and put in a higher high. So that is very important. Obviously, we looked at the potential top at the 0.5. We've come back up and retested that. That's also the purple macro 236. So a slight push higher would take us up to the 618, which is our target, 8108. We discussed the possibility that we have already topped, and then I was just wrong. We're not going to go up any higher, but it seems very likely that we are, in fact, going to go higher. We have a little bit of momentum here. It seems likely we're going to push up here, and then we're going to print bearish divergence and then roll back over. Now, here's the thing. Oil looks like it could pop higher. Energy in general looks like it could slightly roll over. Now, if oil pops higher, energy is probably going to go up. if this thing just goes sideways long enough, it's probably going to go up. As we get into like the cooler and winter months, with like the most likely scenarios that we just go up from here. So energy, not quite as strong as utilities, but still pretty darn strong, and basically like one of pretty much the second best sector in the markets right now. And then we have semiconductors. So it's not technically a sector, but very clearly something that we pay attention to, as it is one of our four horsemen. Very, very important to pay attention to. So we see essentially as semiconductors top out in like their cycles, often that reflects what would amount to basically like a canary in the coal mines for what's happening in the economy. Transportation is very important as well, but semiconductors definitely tell us like, hey, going into the future, if this thing really does go bearish, if it breaks that back down from here, that's not a rosy situation. So we have reclaim and 200 exponential, we have 200 simple slightly above, basically the same exact posture as 90% of the charts we've been looking at. So that's our little overview there. So let's jump over and take a look at crypto next. So we can keep it pretty minimal on the cryptos. Not a lot obviously has changed over the weekend. Like always, the bulls take over for a couple minutes over the weekend, push up the price, and then here we are right back when futures open at the exact same price. So what crypto has basically been completely neutered at this point in time. The derivative market, futures, whatever, has essentially just made crypto just one more sector of the stock market or something like that. And again, if I was going to compare it to something, I would say let's look at these charts next to each other. So this is our Bitcoin futures chart, and clearly just in a disgusting downtrend, just, melting down. And then we have this pathetic little bounce right here. And look how far away we are from the 200 exponential and simple as a percentage. And we just saw like basically everything in the stock market, with the exception of communication, would be the equivalent of 39% higher than Bitcoin is right now. Almost everything in the stock market is at least retesting the daily 200, if not the 200 exponential for sure, if not the 200 simple. And a lot of things are up on top of them. Utilities are all the way at highs. So what does that tell you? It tells us that crypto is extremely, extremely weak. Extremely weak. The fact that it literally looks the same as the weakest sector in the stock market really tells you something. I'm not going to go through a crazy process and put them side by side or anything, but I'm just going to pull it back up so we can kind of look at the parallels of these. Or maybe not. Hang on. There we go. So when we look at these two charts, basically bull trend, and then we've just been rolling over in this descending channel. And here we are, just at the bottom of the range, well off the 200 exponential and simple. And then again, when we just look at Bitcoin, what does this look like? This is it. This is the same exact thing. Same exact thing. Pathetic little bounce off the bottom, still well off the 200 exponential and simple. The truth is, actually, while the percentages won't be the same, communication sector is much closer to the 200 exponential and simple than crypto is. I think it's very important for people to, keep that in mind as everyone's telling you that the crypto bull market has resumed, as many cryptos are off their lows by 50 or 100% right now, how bullish they are. And the truth is, the chart is not telling us that at all. The chart is actually telling us the opposite. It's telling us of everything you should be bullish on right now in what amounts to basically bullish euphoria again, is what I'm seeing and hearing all around. Crypto looks horrendous. Especially, it looks really, really bad. There's literally a handful of cryptos that don't look terrible. And Bitcoin is Big Daddy crypto, and it's one of the worst. Percentage-wise off the highs, it's not one of the worst, but just the overall posture of the chart is just absolutely terrible. Absolutely terrible. All right, so, and again, that does not mean I'm still long Bitcoin. We have still crushed this move to the upside. I crushed Ethereum, we crushed Bitcoin, we crushed a bunch of altcoins. I'm still long. I'm not saying I'm just selling everything and giving up. What I'm saying is that it's important that we keep our head grounded. Because I'm going to tell you right now, if we do have another downturn, the same people that got wrecked already are going to get wrecked again with a bunch of fresh new capital that's going to get taken away by people like me and you. Because we're not trading with our hearts. We're not, betting on all-time highs. We're not gambling with our futures. We're not buying a lottery ticket. We're trading, and we're trading based on technicals. So I love crypto. I think it's definitely the future, blockchain, etc. But the truth is, we're not going to get emotional about it and say, I love crypto and it's the future, so I'm all in and I'm just going to hodl. No, that's not what we do around here. There's plenty of people that do that. And you know what? You don't even need to watch videos on the internet. You don't even need to learn or educate yourself if you're just buying stuff and hodling. Matter of fact, you're probably better off just not looking at it because honestly, if you're looking at your little hodl positions right now, I'm guessing they don't look good. I mean, and by guessing, I mean they don't look good. I'm telling you that. So anyway, here's our Bitcoin spot chart on Bitstamp. Again, just absolutely horrendous. So again, I don't like to go to the shorter time frames, but I'm going to look at a couple shorter time frames. I want to talk about something that I pointed out in the group that is very important. So yeah, we got too many drawing tools, so I'm not going to worry about that. What I am going to worry about is, what I am going to worry about is essentially this peak right here on the 4 hour. That's our Bitcoin peak from July 20th. And then we have another peak right here, a slightly higher peak from July 30th. And then, of course, we just put in that little peak over the weekend right here, a new high on August 14th. So we have a high, then we have a higher high, then we have a higher high after that. And you'll see something very similar here. We get a big candle up, and then we bearishly engulf. We get a big candle up, and then we bearishly engulf. We get a big candle up, and then we bearishly engulf. Right afterwards, the 8 and 21 cross to the downside. We retest the 200 exponential. We put in a lower high, and we retest the 200 simple. Here, the exact same thing, bearishly engulf, 821 to the downside, retest the 200 exponential. We actually do a second retest of the 200 exponential. It holds. We don't make it to the 200 simple. We go higher. And then finally here, our push up, bearishly engulf, getting ready. We have broken down below the 8 and 21. And if we spend too long below these levels, we'll get the 821 cross again. And, it would reason that we would come back down to 200 exponential. 200 simple is right around that level as well. Now, technically, that would still be, overall, here's the thing. Depending on what time frame you look at, Bitcoin is either bullish or bearish. Shorter time frames, Bitcoin looks okay because most of them are on top of the 200 exponential and simple. Now, some of the short time frames are starting to flip back bearish, but at least the 4 hour, the 1 hour, some of those are still on top. The daily is still very bearish because we're below the 200 exponential and simple. And we talk about the overall posture and how terrible it looks. But for the 4 hour chart, we're still long for now. It's a counter trend trade. The probability of success is not that great, but we're already well past our stop loss, our entry price, etc. So we're already winners. There's no way this winner can turn into a loser, but it's worth paying attention to, once we start seeing a high, a higher high, and a higher high, are we going to get any clues off of this chart right here? And obviously, it doesn't take a rocket scientist to see that we have a very high high right here. We have a lower, much lower high right here. And then we have a series of lower highs right here. And then if we correspond that with our, well, first let's look at the Jewel Thief as well. And then you'll see on the stochastics, here we have the highest high. Here we have a slightly lower high. And then again, here we see a series of lower highs as well. So realistically, what does that amount to? Well, here on price action, we have a high. We have a high on our Jewel and our MACD. And then here we have a higher high on price action. We have a lower high on the Jewel and a lower high on MACD. And then again, we have a third higher high on price action. And then we have a lower high on the Jewel as well as the MACD. So we have triple bearish divergence in a daily bear trend in an underperforming asset class with bullish euphoria. Nothing to see here. Nothing to worry about. Everything's fine. We're fine. Everything's fine. So for 1 second, I'm actually going to clear this chart out just so I can draw on it. So I have a couple of things on my short-term chart that I have been basically watching right here. And I want to basically just make this very, very clear what my opinion is and what I think is happening right now. So I'm going to probably snippet this portion of the video, so bear with me for a second. All right, so let's take a look at our Bitcoin Bitstamp chart. I'm on the 4 hour right now, and I just want to point out something that I've been paying attention to that people either haven't noticed or haven't been paying attention to themselves. So what we're going to do is we're going to take our channel tool over here, and we're just going to start at the bottom low right here, the peak low. And then all we want to essentially do is just draw a channel that encompasses the majority of our price action. So something around this level. Now, technically when you draw a channel, you would just be drawing it in real time. So we'd be going to this right here. But now in hindsight, we have obviously a little bit of extra knowledge. So what I see is this is basically just a little outlier, a failed breakdown, or like a spring. So we're just going to kind of skip that, and we're going to go with these 2 points right here for importance. And then this one just kind of pokes out the bottom a little bit. And then we're just going to take our channel tool back up to the top and see how that kind of lines up. So once again, when we look at this, we could draw it just to this first peak right here, but then it doesn't touch anything else. We could draw it to the second peak right here, and then everything else is like poking out the top. Or we could draw it to, our third peak right here, and it seems like it's probably the most viable there. So here we just kind of underperformed the moving averages a little bit. Here we have a little poke out the top, but we have at least 2 clear areas of resistance. And then again, we see, some support. We see some support through here, and then again, resistance at that heartline level. So worth paying attention to. Now, what we know happening right now is we know for a fact that we're in a long downtrend. And we know for a fact that we did something very similar to what we're doing now back here. We basically did something along these lines, depending on how you draw it. Again, you can get creative with it, etc. But the fact of the matter is not exactly how it's drawn, or, is there a right way or a wrong way, etc. The most important thing here is that we're paying attention to, and I think I had it a little more like this. Yeah, that looks about right. The most important thing we're paying attention to is we have a leg down, or, a flagpole, and then we have a bullish consolidation, or, we're slowly just trading inside a range, but the range is going up. So we're going down in a range here, then we're going up in a range here, then eventually we break down and we have another leg to the downside. And that is just essentially just a bear flag. That's all it is. It's a leg down, a bullish consolidation, and then continuation of the trend. And, if we were going to get a rough idea as to, the amount that the trend would be going to the downside, etc., this is what we're going to do. Just take the length of that leg right there, and then we're just going to take it to over here. And, depending on how you want to do it, etc., we could draw it from the peak, how it was here, to the peak right here, or draw it from the breakdown point. That's how I like to do it. You can draw it either way, however works for you, whatever is fine. But I draw it from the breakdown when I'm doing like measure moves. So here from our breakdown measure move, it basically takes us to almost the exact low. And then, what's happening now? We're just doing the exact same thing all over again. We're basically just having another bullish consolidation. So bearish dump, bullish consolidation, bearish dump, bullish consolidation. And then each time when this is happening on longer time frames, what we see taking place is we just basically see here we sell off violently, and then the indicator oscillators just get oversold or tired, or they're just exhausted. So we just sort of consolidate and let those cool back off. And that's a bearish consolidation, or a bearish reset is what I call that. And then again, we resume the trend. So now we're seeing the same thing happen again. The indicator oscillators are cooling back off. They're moving back up to the top of the range. We're seeing triple bearish divergence taking place. So is it likely we're actually getting ready to break back down and potentially out of this channel? Seems likely to me. So, while everyone else once again is getting bullish at the exact wrong moment, I think the best thing to be doing here is actually to be getting bearish, either taking profits or, just expecting much lower price action. But essentially if we just have another leg down, just like the first one, and honestly, just like the second one, it takes us down to about 11,153. Now, I'm not saying that has to happen. Measure moves are not that reliable, but overall, the pattern and the trend and everything we're looking at tells us that we likely have another leg to the downside. And that is what I'm expecting. And if you want the full breakdown of the Bitcoin chart, and essentially what I think is going to happen into the future, my extrapolation of lower prices, higher prices, invalidation levels, all that stuff, you can check that out if you want. But in the meantime, just wanted to basically point that out. And obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Okay, so yeah, I just wanted to do a little snippet that I can do of this and throw out there for people to use. Hopefully it'll let me go back far enough. Oh yeah, we got back to nasty. Okay, cool. All right, so that being said, that is our 4-hour chart. Triple bearish divergence, not looking good. When we go out to the daily, we're not seeing levels of exhaustion yet. We still have a bullish uptrend. We're still hanging out towards the top of the range, but no big red alerts, red alarms, anything going off here. We could easily have further move to the upside, take us that 26, 28 level. We got a couple levels up here. But to tell you the truth, this just looks like slinky theory in full effect. And what is slinky theory? Just some gibberish that I made up. But essentially, it's just a slinky going downstairs. The slinky goes down a stair, and then the back of the slinky whips up in the air. So it looks like the slinky is actually going up. Is the slinky getting ready to go up the stair? It just came down? No, it's just the momentum of the slinky as it moves down the stair, and then its tail whips back up and gives you the impression, actually, that it's going up. But in all actuality, all it's doing is just getting ready to go down again. So here we go down a stair, the rear end of the slinky kicks up in the air, and then we go down the next stair, and then the rear end of the slinky kicks up in the air, and then what's after that? Well, So that's what I'm seeing on our daily chart. We'll look at the weekly real quick here as well. So our weekly chart has essentially just done what we said was going to happen. We broke down below the 200 exponential and simple. We're coming back up, back testing the 200 simple, obviously closing above the 200 simple and the 8 moving average on the weekly. The next target to the upside would be the 200 exponential or the 21, our other two moving averages. So that's 26,000, roughly 850, and roughly 28,000. So right around those two levels we talked about. And again, that would be very strong resistance. Now, if we break through that resistance, we can start looking at it and talk about, potential areas of strength or next targets to upside, etc., which we have laid out many, many times. Obviously, a hard buy signal coming out of the bearish control zone looks good. Obviously a bunch of green histograms looks good. But oftentimes, when we are seeing a move like this take place, again, we're in a downtrend, we see this bearish control zone, and then we get the hard buy signal. And by the time you get the hard buy signal, there's really like one more week of upside, and then like a little poke here, and that's the top, and it rolls back over. And here, when we saw that take place, we came very close to flipping the 8 and 21 back to the upside, and we were also still on top of the 200 exponential and simple. Now the 200 exponential is red. We're on top of the 200 simple, but it's basically flat. We're above the 8 now, but we're below the 21, and we're nowhere near the 8 and 21 crossing back to the upside. Matter of fact, we would need to be above that 28K and stay there for weeks before this would even catch up to it, and then we can start saying that we're close to a similar situation like this. And again, here we are already getting the hard buy, so maybe we do get like 2 or 3 more weeks of bullish price action up to like that 28K, and then we just repeat this exact same thing over again. Doesn't have to happen, but it just happened, so it's worth paying attention to that it might happen again. And then finally, when we look at this monthly chart, and again, we've talked about this on quite a few assets. When we look at this monthly chart, we have confirmed the 821 monthly to the downside. We basically put in what was our bottom initially, had a little pushback up to the upside. We're starting to creep back up here as well, but still very much bearish, very much bearish. Hard sell signal, Stokes angle to the downside. And an important thing to pay attention to also is not only the posture of the Stokes, we have the blue below the purple, as you would expect. And obviously here, if we look at, the distance between the blue and the purple here, and then we look at it right here, and we say, uh-oh, it's accelerating. They're getting further away. They're diverging from each other. And then here we say, oh, now they're getting really, really far away. And then we look here and say, oh, man, they're getting even further away. And now we look here and it's like, well, this is the furthest away they've been. So I don't see any signs on the monthly chart telling me that this trend is even weakening to the downside, let alone exhausted to the downside, let alone about to reverse. As a matter of fact, I would say what we see right here is we're literally flirting with, what amounts to like death as we're about to enter into the bearish control zone for the first time on the monthly. The last time we entered into the bearish control zone on the monthly was back in November of 2018. So it's been quite some time since we've even been in the bearish control zone. Now, that was after, obviously, the big breakdown and what amounted to end up being the bottom. And then here again, same thing back in 2015. So we discussed the possibility that actually this breakdown right here and the confirmation of the monthly cross to the downside was actually the bottom, the last two bear markets. So we discussed the possibility that actually this was going to be the bottom. And as of now, it has been. And we've been able to trade that. It doesn't mean that we think the bottom is in. But if we're right, sure, we picked the bottom. It was great. Awesome job. Congratulations, guys. We picked the absolute bottom. Same way we picked the absolute top. But that's not what we want to do. We don't want to do that. But sometimes it's going to happen. But the truth is, we could very easily just roll back over here and do something we've never done before. We could very easily just do the exact same thing we did previously. But we don't know what's going to happen. But we're going to look for signs of it. And the truth is, the signs right now don't look good. All red histograms, still red slope line. We're below the zero line. I do not like how this looks. I know everyone wants to get bullish on all this stuff, but it's just not the time. And crypto just looks horrendous in comparison. Now look at Ethereum now. What does Ethereum look like? Ethereum has drastically outperformed the majority of other cryptos. And look where Ethereum's at. Still below the 200 exponential and simple, which obviously, if you've been around for any amount of time, we were able to capitalize on this trade setup to the upside, 76%. We have our target up here at 200 exponential and simple, somewhere in between the 0.5 and the 618 and like our longer time frame resistances. But essentially, what does this look like? I mean, it just looks like the back test, slightly underperforming most assets in the stock market, slightly overperforming most crypto assets. But did it really overperform most crypto assets, or did it just sell off so violently that now it's just kind of reverting back to the mean? Because that's really what the moving averages are. We're just looking at the fair value based on the last 200 periods, either exponentially calculated or equal weight calculated. And all we're knowing now is, here we were overvalued because we're substantially above it. Here is fair value. Here we're overvalued. Here is fair value. Here is undervalued. Here is fair value. Here is undervalued. Here is fair value. Here is substantially undervalued. Not because Ethereum's worth more than this, just because if we calculate the last 200 days, we're substantially below. So here, what are we again? Fair value. So what's going to happen from here? We either go back to undervalued and continue to the downside, or we break back above these and then eventually we go to overvalued. Does that mean that Ethereum is actually worth $2,000? No, we don't know Ethereum's worth. It has no worth that we can, measure because it doesn't have earnings. It doesn't have cash flow. There's no way to actually calculate it like how you would calculate a business. So all we can do is just speculate. And the best way to speculate on something is, potentially using like moving averages to see over the last 200 days or 200 weeks or whatever we're looking at. Are we fair valued or are we overvalued? And again, if we look at, or undervalued rather. And then if we look at the weekly chart, again, we were just substantially overvalued in the bull run. And all we did was just revert to the mean. So we're just fair valued back to just slightly overvalued. And what is this? Just the last 200 weeks worth of price action. So while the Ethereum posture looks better than most other cryptos, it's still worse than pretty much every sector in the stock market. So what does that tell you when one of the best assets or the most bullish assets, or, you could argue right now that a lot of Ethereum's strength is because of fundamentals. You could argue it's because of, speculation using, derivative products. Doesn't matter, whatever your reason is. But the fact of the matter is, compared to almost every other asset class, even Ethereum, one of the strongest of the cryptos right now, is still substantially worse than just about every other sector. And then finally, we're just back testing the 821 breakdown on the monthly. And Ethereum did not bottom the same way as Bitcoin did. We saw, essentially 2 more months of downside and new lows before we eventually bottomed. And then even then, we backtest all the way back down and essentially come back down to those lows again. So we don't have that same level of, confluence that we see on Bitcoin with the previous lows. And we don't have nearly as much time to look back at. And as far as Bitcoin dominance, we had discussed, obviously, I'm not going to go into, the thesis and how it played out and then where it actually invalidated. But once we broke back down into this descending, channel right here, basically talked about once we started violating these key levels, what we expected. And obviously taking out that previous low in yellow right here, I drew in this little red box to simulate what I would expect to happen to the Bitcoin dominance chart, which is essentially Bitcoin losing substantial dominance. Now, strangely enough, Bitcoin has kind of been holding up from here. But if this trend continues, if we continue down from here, it makes sense that we would just hit a new low and come back down to the bottom of the range. And then from there, potentially bounce. I don't know. This does not look good for Bitcoin. This is not what you want to see for Bitcoin. Now, you could argue though, well, that's because it's good for altcoins, which means we're probably actually going to go into a big bull run. And that's what's about to happen. And I would say it's possible. It is possible. And then total crypto market cap, again, just doing what we were expecting. We basically bounced at 200 simple. We backtested the 200 exponential. We got above the 8. We're, on our way to retest the 21. You guys know my target is roughly $1.25 trillion. So, it looks like we're on our way to the target, about 1.14 trillion now. So, all right. So that is it for cryptos today. I'm again going to keep it relatively short with some of these other assets because I do have a little something planned that I want to talk about. So gold next. Gold's still very weak. Nothing has really changed here. Again, just back testing the 200 exponential and simple. The GDXJ is gold juniors. Looks very, very similar to gold. Doesn't particularly look good or bad. Just looks the same. And then if we look at XAG, silver, again, very, very weak. Substantially worse than gold. And then again, if we look at the silver juniors, looks almost identical. That is not good. It's not, I mean, percentage-wise, the junior miners are down substantially, but that's not good. You don't want to see the juniors essentially looking the same way as a gold or silver chart because they're highly leveraged. So you would expect when things sell off that the juniors would go down substantially more, and you could expect when they go up, the junior miners would go up substantially more because they're basically like leveraged position or speculatively leveraged position. And the truth is, if we do get a breakdown, we're going to probably see these charts diverge and some serious pressure on the gold and silver miners. So while they've already gotten beat down very, very badly, I don't think that we're anywhere close to bottoming. If silver and gold break down from here, it's going to be a rough ride. So let me jump over in the chat real quick here, and then we'll get into some of the nitty gritty. So Digital Durwood says, keep your rants. They are worth it. Truth is golden. Yeah, I'm just going to kind of like take them down a notch is all. I don't want it to sound like too preachy. And then Logan says, we will roll back, test the low. Just leverage stops being hit. Shorts and longs set. Take profits as buy sells. Now, I don't disagree with you, Logan, but try not to speak in certainty, okay? Say, in my opinion, or I think, or something like that, because that will train your mind to understand that the market will actually do whatever it wants, and no matter how certain you are on something, it's not going to do what you want, no matter how certain you are. So sort of like train your brain and kind of reprogram yourself to use terms like I think, or we likely, or, give some kind of reasoning why. Don't speak in certainties because there are no certainties in this market. We are on the 5 average at low. We on the 5-year average at low. I'm not sure what you mean by that, but was 3-year then 4. I've seen orders to buy higher than the buy price in order book. Shorts protecting their profits. Okay. Lower low incoming. Okay. So yeah, I think I made my point there though. But yeah, next we'll go on to the DXY. So the DXY obviously has broke down, and we see the 821 have crossed the downside. We were back testing them as resistance, trying to rally back up here. I suspect the DXY will just go kind of like sideways and float around here for the next couple weeks while we're waiting for that next Federal Reserve meeting. So obviously there's not one in August, but September we have another Fed Reserve meeting, Jackson Hole, at which point in time we'll likely get another either 75 basis point hike or 50 basis point hike. So once again, when they hike interest rates, that essentially, because the DXY is a relationship of the dollar compared to, the basket of currencies, when the rates go up, for the interest rates go up, the Fed funds rate goes up, the DXY will strengthen in relation to the other basket of currencies, because now our rates in comparison to other countries' rates are higher, so we're stronger. The same way that if we cut rates, that we would expect that relationship between our currency and others to diminish. And obviously, because it's a basket of currencies, it's not as affected if just one country was to raise rates. Let's say tomorrow, Canada was to come out and just jack interest rates by 10%. We would see the DXY weaken, but not nearly as much as if we went to just the dollar compared to the Canadian dollar. And vice versa, if all of a sudden, let's say Canada just went into a massive recession or whatever, and they just cut rates and made them negative, we would see the Canadian dollar weaken extremely compared to the US dollar, but it would be reflected in the DXY chart as a much less substantial move, but again, as the dollar strengthening. So it's very, very important to remember that the percentage interest rates in comparison to the other countries in the basket of currencies is what we're looking at here, the relationship. So it makes sense that the dollar will strengthen when the Fed hikes rates again. So if the market is convinced right now that actually the Fed is going to start loosening again, definitely not tightening. And, we're going to go back into, QE instead of QT. If that is correct, which is what the market is saying right now or speculating on, then, obviously the dollar would just weaken from there, as we would stop raising rates or cutting rates or whatever. And other countries would, we would presume continue tightening. So we don't know what's going to happen in the future. We don't know what the next announcement is going to be or whatever. But that's how the situation would kind of play out and the relationship between the two. So, but realistically on the dollar, this thing is probably getting close to bottoming, at least temporarily, before it goes higher. I'm still very, very bullish on the dollar. But essentially, we're just kind of chopping around, letting our indicator oscillators reset. They've come all the way from the bullish control zone to the bearish control zone, and we've only come down a couple percentage. So, we see obviously the histogram has come all the way from extremely high levels all the way down to, well below the zero line. The slope line has been red for quite some time as we continued up. So as it continues to roll over, if we do ever flip it back blue and go to the upside again, we basically just have a full tank of gas ready to go. All right, so now I want to take a look at, I know a lot of people get frustrated with the strength of the U.S. stock market. And I know people are getting frustrated with the recent move. Even though we expected it to happen, I think it kind of took a lot of people by surprise. I was getting comments such as like, I'm shorting everything, or, if we can't short now, then when can we short, and all that stuff. And, or people getting like extremely bearish. Part of the reason it's holding up is because it's literally designed, the indexes, the major indexes are designed to pick the best stocks. The absolute best stocks. So if you have, a market and let's say, 5,000 stocks or 5,000 assets, and if you pick the best 10 and they make up 50% of that index, you would expect that index to stay substantially stronger than the markets if the market's in a bear trend. And, vice versa. If the market's in a bull trend and, it's made like mostly consists of underperforming big cap stocks, you would expect the broader market to outperform that index. So with the Dow Jones, the S&P, the Russell, and the Nasdaq, there's a lot of overlap between them. And also like the top 10 stocks in those indexes make up, 30, 40, 50% of the index. So really what you're doing is you're betting on those major stocks and then a little bit of like market cap, like weight of like whatever else there is. But it's essentially just what we always talk about, which is long the strongest, short the weakest. You're betting on the strongest with probability that they would continue to be strong. So let's go over and take a look at some of those. And, if you have never looked at what's the stock market is composed of, the major indices, it's definitely worth taking a look. And we're going to look at basically those top stocks and sort of see how they look and what is that telling us about the broader market, which ones are giving strength to the indices, and then which ones are, giving weakness or taking away from that strength. So first we have Tesla. Tesla is, just because I'm just kind of going through the same order that we normally do, not because it's like a bigger market cap or anything like that. There's nothing to do with that. In these, you have to go look all that stuff up on your own. Well, what percentage of what sectors in each market, what percentage of, which specific stocks, et cetera, et cetera. So starting with Tesla here, Tesla is obviously neutral. It's in between the 200 exponential and simple. It technically confirmed into a bear market, but this is really just the initial back test since that happened. So Tesla is giving overall, I would say it's giving a little strength to the markets, to the indices, but not really. I mean, it's basically just neutral. The chart looks very similar to everything else. The recent move right here is only the extra kind of like strength and how well it held up till here. But once it broke down from here and we saw this big move to the downside, it essentially overperformed or held up better than most things here. And then when it sold off, it still did better overall than most things. But this aggressive move right here, now the move we saw back to the upside essentially has made up for that. So again, just back to like fair value. So Tesla not really giving much strength or weakness to the markets, shorter terms. Next we have Nvidia. Obviously Nvidia, big company, big stock, very important, semiconductor industry, etc. What are we seeing from Nvidia? Nvidia is still very much in a bear market and underperforming. It's still well below its 200 exponential and substantially below the 200 simple. So, we looked at the semiconductor ETF and see how they look. And then we're seeing what are semiconductors right now, what is Nvidia right now doing to the indices that it's inside of. It's dragging them down in relation to some of the other stronger stocks. So weakness from Nvidia. Next, we see Amazon. Amazon, obviously, big stock. Again, this thing has severely underperformed for quite some time. And if we look back in time and we say, okay, when we hit the lows back here, we were basically retesting levels from 2018. So very, very weak. So it was very, very weak and gone sideways and underperformed for literally years. And then when it sold off pretty aggressively, around the same as most of the rest of the market did, around like 45%, something like that. But now the move back to the upside has been pretty aggressive. But again, we're just back at the 200 exponential and simple. And posture-wise, it looks like the majority of the market. So while Amazon's not necessarily dragging the rest of the market down, it's not doing the market any favors. It's not doing anybody any favors. Next, we have Google. Again, Google underperforming, still below the 200 exponential. We would expect it to be somewhere in between the 200 exponential and simple, closer to the majority of the sectors that we looked at. So again, we're seeing weakness from Google. Overall, it's dragging down those major indices. All right, so now for some strength, we see Microsoft looking much more like everything else. Backtesting, 200 simple now. Very much just one of those like neutral ones in between the 200 exponential and simple. Not particularly strong, not particularly weak. Obviously, we had trade setup in this that played out beautifully. The inverted head and shoulders explode to the upside and hit our targets. Next, we have Apple. So what is Apple doing for the markets? Well, obviously, Apple is much, much stronger than what we're seeing from other stocks, from other indices, etc. So while we're still putting in a high, a low, a lower high, a lower low, and then as of now, still another lower high. So we're still very much in a downtrend. We're still very much in a descending, broadening wedge. But the truth is, Apple is giving strength to the markets. Apple is giving strength to those major indices. So Apple has a lot to do because of its weighting and because of its overall posture. Apple is actually very much responsible for propping up the markets, at least those indices. But essentially what we're looking at is something like, this is a little ugly, but something like a descending, broadening wedge, which could break in either direction. But we literally went from all the way at the bottom of the wedge all the way to the top of the wedge. Honestly, I think this is really how we have it drawn before and how it should be drawn, and that this was actually just like a little bit of a spring. But, essentially we have moved all the way back up to the top of the wedge. So when we came down to the bottom of the wedge, we go back to the top, then we came all the way down to the bottom, then, eventually go back to the top. So we're still trading inside the range, even though it looks like Apple is just crushing it and it's just breaking out and it's just bullish and going back to the moon. It's very, very strong compared to most of the markets, but we're also at key resistance levels. So do we see continuation on Apple? I don't know, but obviously it's picking up more than its share of inflows and momentum, substantially outperforming the markets. And, if you go and look at, Apple and its overall weighting in the markets, you will see, for instance, if we look at Apple and its overall weighting in like the S&P 500, Apple is 7.1% of the S&P 500. 7.1%. I mean, that is substantial. So essentially the strength in the S&P 500 is not solely responsible. Apple's not solely responsible for it, but I mean, it's definitely helping. And, you have 6% Microsoft, you have 3.7% Amazon, you have 2.4% Tesla, you have 2.2% Google A, and then 2% Google C. So, 4.2%. You have Nvidia is number 7. You have Berkshire Hathaway is 8. Meta is 9. And then United Health Group is 10. So how many of those are the charts that we look at every day are the strong charts, in the market? And how much of the actual market is literally being held up by a couple of these stocks, and how much of the indexes is essentially weighted with these stocks and being held up by them as well? I mean, a lot of people just don't realize how important this handful of stocks is to the overall market. So now if we look at Nasdaq, securities by weight, again, Apple is 12.25% of the Nasdaq. 12.25%. Microsoft is 10.6%, Amazon 6%, Tesla 4%, Alphabet A and C, almost 8%, Nvidia 2%, Meta 2%, PepsiCo 1.2%, Costco 1.1%. So, but again, how many of those names are the same names? How many of those are the exact same names we just looked at? And, is it Apple and Microsoft are literally on their own 23% of the index. And if we throw Amazon, Tesla, and Alphabet, Nvidia in there, now we're talking about, almost 40% of the index is just those couple of stocks. I think a lot of people just don't realize that, how important these couple stocks are to the market. And then I'm going to make a little conclusion at the end and hopefully, make my point, drive it home or whatever you want to call it. So, but yeah, very, very much worth paying attention to. I think a lot of people do not realize that. And I think it's very important to realize that because it has a substantial effect on the markets. These couple of stocks do. And matter of fact, let's talk about it right now. What's really important about these is we see right now that historically we can look at active versus passive investing. Active being, you have a manager or you're, making plays one way or the other. Passive is basically just, regular money flowing into, an index fund or something like that. And you're just making regular payments into it. And you're not like, trimming or cutting back or rebalancing, et cetera, necessarily like actively the same way you would. So it's basically the difference between the passive and active. As of late, we're at record all-time highs for passive investing. So where does most passive investing go? It goes in index funds. And what are those index funds made up of? Apple and Microsoft and Amazon and Google and Nvidia. And so it's really these 10 names are holding up the entire market. Because if we start just looking at random stocks in the market, they look substantially worse. Especially if we start going out into like profit-less companies and stuff like that. And then if we start looking at like trash ETFs, like Cathie Wood and, some of these other ones, we see they're just absolutely destroyed. And then we look at what they're composed of, and they're composed of a bunch of trash, as opposed to, our major indices, which are just the same 10 stocks, basically. All right, so next we have United Health Group. So again, we find this is a big portion of our major indices. Once again, this is our top weighting in the Dow Jones, 9.6%, almost 10% in the Dow Jones. And obviously we know that healthcare is a safety sector. We discussed that obviously well in advance. And healthcare is outperforming substantially. Arguably the best looking chart right now is it's about to put in new highs. And then again, we see a small little percentage in the S&P and, so is United Health Group giving the markets strength or weakness? Is it giving them, positive or negative? I mean, obviously positive. I mean, this thing's about to break out to new all-time highs and absolutely crushing it. And we know that's over 10% of the Dow Jones. So if we look at the Dow and we say, okay, hang on a minute here. So, United Health Group is over 10% or around 10% of the Dow Jones. And then we say, okay, what's the other strong stocks? And is there at least one of them in every index? And is that why the indexes are doing so much better? I mean, it is. It definitely is. So next we have Amgen, again, another healthcare company. Amgen is like 5% of the Dow Jones. And this one is not as strong, obviously, but still very, very strong. We see a long consolidation period through like 2020. And we're back basically, chopping around above the 200 exponential and simple, trying to, basically get ready to break to new highs. So overall, is this giving us strength or weakness? Obviously giving us strength. On to the next. So then we have Goldman Sachs. So what is Goldman Sachs doing? It looks a little better than the overall sector does and a little better than our, financial banking, whatever. But again, barely above the 200 exponential and simple. It's not hurting necessarily the indices, but it's not doing them any favors either. Next, we have Home Depot. Home Depot is underperforming. Most other indices are at least between the 200 exponential and simple. This one is just now tagging the 200 exponential. So, not particularly great, but slightly underperforming. Next, we have McDonald's. So McDonald's, back above the 200 exponential and simple. I mean, this looks more similar to, if we were going to compare this to a chart, what does this one look like? I mean, it looks like Apple, right? We had a high, sold off pretty heavily, kind of chopped up, and now here we are basically back at those highs again. So McDonald's, is it giving strength to the overall markets, or is it taking away from them? Obviously giving strength. And again, McDonald's, 4.5%, 5% of the Dow Jones. Caterpillar next. So Caterpillar obviously showing some weakness here, underperforming the overall market, still below the 200 exponential and simple. Salesforce is next. Again, underperforming, still below the 200 exponential and simple. Not doing them any favors. Looking pretty tired right here. We do have what it looks like to me, a ascending triangle or something along those lines. We have a low, then we have a high, then we have a series of higher lows, and then essentially just another test of that same high. So if we do break out of here, we would expect to get the measure move, back test of the 200 exponential, 200 simple, and probably that previous peak. And then we start looking at it and saying, oh, okay, so does that mean it's back in a bull market? Well, we have a leg down, then we have a little bounce, then we have another leg down. So we have a high, we have a low, we have a lower high, we have a lower low. So if we come up here, we get back above the 200 exponential, back above the 200 simple. Now we're back in a bull market potentially. Then we take out the previous lower high. And then at that point in time, we threaten back up here, start moving back to the top of the range. Seems reasonable. It doesn't have to happen, but it could. Next, we have Honeywell. So again, Honeywell, up like over 4% of the Dow Jones. Represents, obviously one portion of the industrial sector, which we see is overall underperforming. The sector is, but we see Honeywell is overperforming in relation. So above the 200 exponential, above the 200 simple, threatening that previous swing low, or swing high rather. So we see Honeywell is actually giving a little bit of strength in relation to the rest of the market. It's definitely not dragging it down. And then next we have Boeing. Boeing is obviously absolute garbage, straight up trash. Not just the products they make. They're garbage planes that just fall out of the sky, but just everything about how they run their business, and also like the overall performance of Boeing. Obviously it's just complete trash, garbage. I mean, it's really good leading up until, and like as of late, now it's just complete trash, garbage. 256 was the peak back in May, and then prior to that, we put in the all-time high right here. But when we actually look at the overall performance of Boeing, I mean, it's literally threatening the 200 exponential on simple on the monthly. We don't see a lot of things doing that on a monthly time frame. And if we just go back to the weekly real quick, Boeing has confirmed into a bear market already as of July. So is Boeing lying, or is Boeing just underperforming and just telling us what's likely to happen going into the future? Well, let's look at this Boeing chart and see, hey, what did Boeing do before it confirmed into that bear market? Well, here it loses, the trend, comes all the way back up, reversion to the mean, return to fair value, and then rejection. And then at that point in time, it just melts back down. Now, is it going to new lows? I don't know. Is it going back to retest the 200 exponential and simple? I don't know. We'll have to wait and see. But is Boeing being honest with us? Is Boeing just a trash company? I mean, you make your own decision. But on the daily, it's not doing the markets any favors. It's not killing them right now. But overall, Boeing is dragging down these major indices. Next, we have Visa. So obviously, like, financial, banking sector, et cetera, whatever. I have Visa, basically peaked out here, still in a bear market, but it's constantly banging its head on the moving averages, trying to flip back over. As where everything else was just kind of melting down and the moving averages was catching up to them, it's constantly been just fighting to try to get back above them. So I think it's actually giving a little bit of strength to the markets. Even though it's still just above the 200 exponential and simple, it's okay. But these little moves up right here, and it's staying close to the 200 exponential and simple, overall really helps out the overall indices. And then next we see American Express. So look how we see the difference between Visa and American Express. And what do they represent? Visa peaked back here in July of 2021. American Express peaked right here in February of 2022. So Visa peaked way back, July, way back here. And then since then, American Express has continued to put in new highs, come back down, new lows, new highs again, come back down, lower high, and then new lows here, back in between the 200 exponential and simple. What does that tell us? Well, who typically has an American Express? Someone's going to pay off their card, someone with a better credit score. And if you have a better credit score and you're going to pay off your card every month, you're probably, better off like financially, or more educated or responsible, more successful. Not to like put anybody down if you don't have an American Express. I'm just saying, typically, if you look at who has an American Express versus who has a Visa, we're looking at two different groups of people. So American Express holding up stronger tells you, okay, actually we have like a bifurcation in the market where essentially like, hey, the people that are like more well off are doing better, and the people that are, not, but still okay because they have a credit card. Obviously, if you don't have credit card, it's different everywhere, but in the United States, like literally everybody has a bunch of credit cards, unless you're like, what's a nice way to say this? Unless you already burned all your bridges and now you're not allowed anymore. Because, when I was in college, I literally, went to college. I was, 17? I was 18 years old when college started. I think I was like literally just turned 18, like a week before college started. And when we walk onto like the college campus for like our first couple of days of school, there's literally tables set up and you can sign up for a credit card. Obviously, when you're 17, 18 years old, it must have been slightly after. I turned 18, I think, a week before school started, and immediately got a bunch of credit cards. No credit, never had a car payment, never had, any credit built before that, and they're ready to just hand them out. I didn't have an American Express, I'll tell you that much. So, just kind of says like what to expect and kind of how it reflects. So next we have 3M. Again, 3M peaked a while back. January of 2018 was the peak on 3M. January of 2018. So when we came back up here and put in this high during, the Rona run, this was May of 2021. We didn't even come anywhere near the peak all-time high from 2018. So is 3M like in relation to overall doing well? If it didn't put in a new all-time high in this massive bull run right here, 3M is clearly trash in comparison to, the rest of the market, because just about everything put in new all-time highs in this bull run. And all 3M did was just recover a percentage of its drop, and, pretty pathetically did so. And then after that, where'd it go? Well, just straight back down to those lows again. And now if we look at, the more relevant, like local data, is 3M helping the market or hurting the market? Well, basically, it's not doing it any favors short term, but essentially it's just back testing. Doesn't look good. And then when we look at our longer time frame charts and we say, okay, what is 3M telling us? Well, this is what it looked like when 3M went into a bear market on the weekly. We basically sold down below the 200 exponential and simple, back tested it, new lows, came all the way back up here, flipped the 200 exponential, back blue, got all the way back on top of the 200 simple, consolidated on top of the 200 simple, and I guarantee you on the weekly right here, everybody is saying, oh my gosh, 3M is going back into a bull trend for the first time in 3 years on the weekly chart. This is it. This is the big one, going to new all-time highs. And then what happens shortly after that? It rolls back over and melts down. So just imagine we're on, say, a daily chart right now. And just imagine that we're looking at, well, what should we say? Let's just pretend this is the Dow Jones. Does this look similar to the Dow Jones? We put in a peak, a series of lower highs, break down below the 200 exponential and simple, come all the way back up here, back test them, and now we're back on top of the 200 exponential, at the 200 simple roughly. So right here, would you be getting bullish on this? Would you be getting bearish on this? Would you be taking profits right here because you bought at the bottom? Or would you be loading up right here because we're about to convert back into a bull trend, only to find out shortly afterwards that you, like many other people, are a sucker and fell for what was essentially just reversion to the mean backtest? Now, it doesn't mean this doesn't go back up here and then eventually go back into a bull trend, but this is very clearly in a bear market on a weekly, and it's very clearly we have a high, we have a low, we have a lower high, and we're still in the middle of this move. Now, technically, it is a slightly higher low right here, if that is the low. But realistically, what's probably happening? Probably something like this. We're probably just a high, a low, a lower high, a lower low, a lower high, a lower low. This is the macro low. These are our macro highs. And then this is probably just, a low, a high, a lower low, a lower high, a lower low, lower high or something like that. Or maybe this is just the high, that's the low, and this is going to be the lower high. But likely we put in a new lower low. And then if we look at the monthly, we will see something like 3M on a monthly chart, again, extremely, extremely weak in comparison to most markets. Not very many assets right now are at the 200 exponential and simple on the monthly. This is an absolute dog. And to tell you the truth, when I look at this chart right here on the monthly, and we see this is our high, that's our low, that's our lower high, and we actually already put in a lower low on the monthly, it just tells me whatever happens next is going to be a lower high and probably a lower low. And then eventually, we're going to be borderline, confirming into a bear market on 3M. And has 3M been in a bear market on the monthly since 1968? No, it has never been in a bear market since 1968. So you could argue, well, then it's not going to go in one now. That's the bottom, and we're going back to up to the upside, just like we did right here. And I would say it's possible. It is very possible that that is the case, and that this is the bottom for 3M, and we're just going to rip to the upside now. It is possible. But what if it's not? What is 3M going to look like if it does confirm into a monthly bear market for the first time in existence in the last, 50 years? No. Well, yeah, somewhere around there. Next, we have Chevron. So obviously, energy stocks have been doing quite well, but it's important to remember these have been dogs for a long, long time. A long time. Chevron put in its peak in 2014 and then retested the peak in 2018, 2019, and then rolled over and put in a new low. And it wasn't until we broke above that 2014 peak right here, essentially, that we went to the new all-time highs. And now, obviously, we're consolidating. We're seeing a little weakness, potential that we're, getting tired, going to roll over for a little bit. But obviously, we're just now confirming into a bull market on the weekly after that long, multi-year consolidation. So energy stocks have been hurting the market for literally like years and years and years and just completely underperforming. And now only in this last year or so have they actually been overperforming. And part of that was because everyone was underallocated, and there was lack of investment and, a clear green agenda against energy and, just a lot of reasons why. But now when we look at them, are energy stocks giving us strength or weakness? Obviously, they're giving strength. I don't have to tell you that because it's some of the only decent looking charts in all of the stock market. So that is Chevron. And then here we have Exxon. Again, very similar. Very similar. We have that 2007 peak back here in Exxon. And then we put in a slightly higher high in 2014. But even right now, where we're at right now is back at 2007 levels. So if you bought at the peak in 2007, Exxon, and then you just waited a couple years, roughly 15 years, you're back to break even. So that's good. After 15 years of going sideways to down. So could you understand why they're not exactly excited to just dump a bunch of money into their company while the green agenda and the current administration is basically saying we hate you and you're going out of business and we're going to do everything we can to regulate you into the ground? And they're just thanking God at this point in time that they're back to break even from 2007. Obviously paying nice dividends, etc. But now, is this going to be the top? Well, hard sell coming out of the bullish control zone on the monthly, and then, complete meltdown after that. Hard sell coming out of the bullish control zone on the monthly, and then, literally complete meltdown after that. Hard sell coming out of the bullish control zone. I mean, I don't know. I would be careful if I was. No, you get the point. But these have been a drag on the market, and only as of late are they actually helping. All right, and then finally, we're going to look at, I got a couple more, and then I'm going to do a little conclusion, and we'll wrap it up there. Next, we have Costco Wholesale Corporation. Everybody knows what Costco is, obviously. Well, I don't know. If you don't live in the United States, or maybe you don't know what Costco is, it's basically a giant, store with a membership fee, and then you can buy things essentially in bulk at a discount. Who shops at Costco? Not the same people that shop at, your just average Joe grocery store. They're typically a little more financially, better shape. purchasing things in bulk. So it's not, when you're poor, you can't buy months worth of what you need. You go to the store and you buy maybe a week's worth of what you need. Or when you're really poor, you like leave work, take your money that you just earned, like waitressing tables or bartending or whatever, and then you immediately buy the stuff you need to make dinner for your family. Excuse me. Hang on one sec. Let me clear my throat. You buy basically the bare necessities for what you need to feed your family for like a night or two, and then go back to work and do it all over again. So again, we see this is more of like, giving us more of like the demographic of, say, what did we say earlier? Visa versus Master, or Visa versus Amex. This is going to be more like your Amex, as where something like Walmart or Target or something like that is going to be more like your Visa. And then, the dollar store is going to be like your, like, what do they call it? Like it's not like a debit card, but it's like a preloaded credit card. So it's basically a debit card, but you can build up, I don't know what it is, regardless. So we see Costco basically is strong. It's not at the highs, but it's still above the 200 exponential and simple. It's substantially stronger than the market. We don't see any of the major indices, looking like this except for energy and utilities. So again, Costco staying very strong, telling us, again, that bifurcation. Next, we have Walt Disney. This one is specifically, it's in Dow Jones. Everybody's familiar with it. Obviously, it's not some like huge part of the index or something. It's like 2.5%. But lately, all we have been hearing about is Disney and how good Disney is and all this stuff. And I just want to make sure that people actually realize, that is not necessarily the case. Disney has just now reached 2015 highs. Okay, now it did put in a new high since then, but just remember, it's back at 2015 highs. So either Disney was overvalued back in 2015 or it's undervalued now. And the reason I say that is, well, I'm pretty sure they've done some stuff that's important since 2015. I mean, they've added some attractions, they've put a bunch of money into their parks. They created a streaming service. There's definitely some stuff going on with Disney. So why is it back at 2015 levels if it's not trash? Or is it trash? I mean, that's up to decide, up to you to decide. But the fact of the matter is, this is a dog. If you just held this thing for 7 years, you're break even. That's absolutely terrible. What did, even a basic index in the last 7 years has absolutely killed it. So while Disney is, this is a complete drag on the major indices. Now, it's not a huge percent. Like I said, it's only a couple percent. But imagine, and this is where I'm going with the whole stream. So get ready. This is my like seamless transition. Damn, I just ruined it by saying that. Fuck. I'm just kidding. But let's just say, for instance, okay, you could buy those major indices, but not have some of these dogs that are dragging it down. Some of these underperformers. Are you going to then miss out because eventually they're going to overperform like what, Exxon and Chevron have done as of late? Or are you just basically saying like, oh, okay, actually, if I had the same portfolio, if I was to buy the Dow, but without Disney in it, would I be better off or worse off over the last decade? You'd be better off because it's been an absolute dog. And what about as of late? Is this good or bad? I mean, it's pretty damn bad. It basically like melted down completely. It's only now getting close to backtesting the 200 exponential and simple. And even then, it's nowhere near getting back on top of, well, I shouldn't say nowhere near, but another $10 just to get back on top of the 200 exponential and simple. The slope is still aggressively angled to the downside because it's been just melting down in this bloody waterfall. And then even after that, we still have to go all the way back up another like $30+ just to start taking out the previous swing highs. And then after all that, assuming we can finally get back up here to threaten the all-time high, that's $80 from now. What's going to be the catalyst that all of a sudden Disney's at all-time highs? Like, more people going to be going to Disney? Or is Disney like only outperforming like your, what are like some of the other ones, Six Flags and stuff like that? Think about who goes to Disney and think about who goes to Six Flags, okay? Six Flags is where you go if you're poor or less fortunate and you want to go to an amusement park, okay? Six Flags is the Walmart of Disney's, okay? Disney, obviously, expect to spend a couple grand. People travel literally across the country, across the world to go to Disney. Realistically, if you have a couple kids, a wife, yourself, you get a hotel, you do the whole thing. When I say a couple grand, I mean 5 times that, probably 10 grand. So who's going and spending 2 grand, 5 grand, 10 grand at Disney? Bifurcation of the market. Once again, we see the top people doing better and the bottom people doing worse. So is that sustainable over time? Is it possible that we could have a bunch of people doing really good for a couple of years and a bunch of people doing really bad for a couple of years and not have, civil unrest or, crazy volatility in politics, in, everyday life, etc., looting, rioting, whatever? I mean, it's not sustainable. We know that. And now it's more evident than ever. We're seeing it literally across the board on these, the difference between the same business operating in the space or multiple businesses operating in the same space, but one geared towards the high-end consumer and one geared towards like, if you want to do this, but you don't have the money for the good stuff, here's basically like the half-ass version. So again, Disney, a complete dog. And all I hear nonstop is how Disney is the best investment. It's on everybody's buy list. Grab up Disney while it's still cheap. The future is Disney because of the streaming, because the blah, 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 blah. According to the chart, the best thing you could have done for the last, what did we say, 10 years? The best thing you could have done is not own Disney. Not have any Disney in your portfolio. What did I say? 2014, was it? Yeah, 2014. 2015 maybe. So 7 years of not owning Disney would have been probably a great decision. I mean, the only thing that would have been worse than or better than not owning Disney is probably not owning Intel. Then really had to get a jab in on Intel. It's not bad enough that it's trash and all it does is lose money. You gotta poke the bear. Okay. All right, and then last but not least, we have one more. And Disney. And this is Kellogg Company, that's Special K. These are two that everybody's talking about right now. What am I hearing about Kellogg's? They're saying Kellogg is breaking out to a new high. It's breaking to a new high. It's extremely bullish because it's breaking to a new high. Sure, it's taking out the recent high right here. It's on top of the 200 exponential and simple, which is good on the daily, but it is not breaking to a new high. This is our 2016 high on Kellogg. The 2016 high on Kellogg was at $86. We're at $75. So again, this thing is an absolute dog. An absolute dog. And everyone's talking about how great it is because they're about to spin off part of their, company. Why are they spinning off part of the company? Because it's dragging it down because it's trash. This is a dog. Now, granted, it's starting to look okay on like the weekly, but it's been terrible. Look at how long this thing has spent retesting the 200 exponential. Now, it is good that we took out the 2020 high. It is good that we took out the 2018 high. But before I will gain any confidence in Kellogg as like an actual company that I want to hold long term, I want to see it above $82.52. And we might not see that because by the time the spinoff happens and everything, and then, all the little changes and the price adjustments and everything, it's going to be a lot harder to look at this chart and see what's really going on. But, essentially, if we go up another like 10% or so, we break out to new all-time highs, I'll get excited. I'm not going to be the guy who buys the retest of all-time highs and then it rolls back over and fails. No, thank you. That's idiotic. But it does look, as of late, though, it has looked strong. But does it look strong as of late because it's strong? Or has it just looked strong because it's been so bad for so long? And again, obviously, this is, helping out the market as of late. But it's been dragging it down for 7 years. So yeah, that's what I just wanted to, basically just, I try to like do some stuff occasionally for perspective, just to kind of like give a different angle on things or like, stuff that people might not be seeing. And I think it's very important to, pay attention to what we discussed today and see how that like reflects on the overall, market. And, what would it be like if you could just buy the Dow Jones or the S&P and not have a couple key stocks in it? If you just like X them out, would that do better over time? Would you miss out on big runs on things like energy when they finally do perform? Is it worth 7 years of underperformance for 1 year of performance? Because then it just averages out to like, it helps when you need it and then hurts the rest of the time? Or would you be better off, kind of positioning yourself accordingly? And then, what are the ways you could do that? What if you did want to take advantage of this strategy? There are ETFs out there that take out some of the dogs. Now, here's the problem. Some of those ETFs, I'm not going to call one out by name, but some of those ETFs they say they're going to do one thing, and then they have a formula where they do all this work, and then they say, okay, this thing is a dog, so I'm going to get rid of it. But like, for instance, one of the big funds that does that, like X'd out Tesla. And it's like, well, what are you using that's telling you that you don't want Tesla? Because, and without seeing like your proprietary formula or whatever, I would have to say, well, actually, you're a dumbass because Tesla has been crushing it. And other examples like that as well. So what's the other way without getting too complicated? Because you can't just buy Dow Jones minus, whatever it is you don't like. You can go overweight in sectors that you do like, or you can buy specific stocks that you do like. So if you were going to construct a portfolio, starting from scratch or with nothing in it, what's the, looking at the overall markets and the way to do it, and knowing that passive inflows are at like record highs and that the indices are holding up substantially better than, individual stocks. Well, the smartest thing to do would be to just buy the best stocks, theoretically. But you should diversify just in case something like Apple just rolls over and melts down. If you're all in on Apple, you're going to take a massive hit. But if you say own equal weight, say you own, well, let's just use the little mini. If you were to say buy like one of the DIA 337, and then you were going to buy one of the SPY 427, and then you were going to buy one of the Qs 330, and then you were going to buy one of the Russell. You would have a slightly weaker weighting on the Russell, or maybe you buy 1.5, and then they're all right around like 300-400, somewhere around there. Then you would have a pretty balanced portfolio. You would be overweight, quite a few things that are all performing pretty well. I mean, you're going to be overweight, Tesla, obviously. You're going to be overweight Nvidia and Apple and Microsoft and, United Health and all those things that we discussed. And then on top of that, once you have a nice base form, you're going to have exposure to, a bunch of other companies, somebody else doing all the work, picking what stays, what goes, etc. But then on top of that, then you can start saying, okay, I have a nice base for my portfolio. Now I want to expand that portfolio and I want to put some pot stocks in there. So I'm going to do 5% pot stocks. And then you say, well, actually, I like miners too, like gold and silver miners. So I want to do like 5%, miners. And then, whatever else. Maybe you're like super, super bullish on Apple. And you're like, you know what? 20% of my portfolio in Apple is just not enough with these major indices. So, it's not quite that high. But so you're like, okay, I'm going to get a couple Apple stock as well. And, I really like Amazon going into the future. So I'll get a couple of those. And, you can go through then and supplement that. But I think what people forget is that a lot of thought and literally decades of knowledge have gone into these indices. And then on top of that, not only are they like overall good products, but the passive investing structure of, like current existence on Earth tells us we're going to still see probably lots and lots of inflows, whether it's people's retirement or just, passive investing through, for whatever, all this money just keeps flowing in. And then every time the money flows in, 10% of that money's going into Apple, 7% is going into Microsoft, whatever, just right down the line. So it makes sense to have a portion of those because they're going to continue either overperforming to the upside or when things go down, not going down as much. Now you're going to have your black swan events or your big dumps where all of a sudden maybe Apple melts down a bit or something like that. But I mean, when we look at the overall condition, we just looked at a couple of the dogs and just saw like, wow, how salty would you be if you were in those for years and basically just now got back to those levels? And then we can look at something like Microsoft and we say, okay, Microsoft actually back in 99 the dot-com bubble burst melted down, and it went sideways till it finally took out its high back in 2016. But since 2016, I mean, look at this. It's basically just straight up. Now, don't get me wrong. When we look at this chart right now, it looks real tired. It looks real tired. I mean, if you showed me this chart and I didn't know what it was, I would say, oh, it looks like it's actually getting ready to come back down to like backtest 200 exponential and simple on the monthly. I mean, this looks real tired. Now, it can save the trend. It could likely even come back up here, you know, bump its head back on the blue slope line and then roll over and put in either a higher high or lower high, potentially even develop divergence, and then roll over, melt down, whatever you want to call it. But I mean, look at the difference between something like this versus, you know, one of these dogs. And then let's look at like Apple, for instance. You know, would you have done better if you were overweight on Apple or underweight on Apple? I mean, look at this. You know, Apple peaked out in 2000 right here, and then this was the sell-off for Apple in 2003, and then it was already back at new all-time highs by 2004. So Microsoft took forever to get back to all-time highs, and you know, Apple was already ripping since then. So would you have done better if you were overweight Apple this whole time or underweight? I mean, obviously overweight. I mean, it's crushing it. So I don't know. I think a lot of times people get hung up trying to pick these winners and go out of their way to like find some like gem, some diamond in the rough so they can like outperform the markets. And it's like, well, actually, if you want to outperform like the S&P or the Dow Jones or, you know, some other metric, probably the best way to do it is just overweight in something else or underweight in something that's doing poorly. Rather than just trying to like start all over on your own and pick what you're going to own and only have a couple things and have limited diversity. And, you know, in the end, I think the best way to do it for portfolio construction, especially if you're like starting from scratch, get a solid foundation of major index funds. And then you can go a little overweight in certain things, couple certain sectors, etc. Pick a couple specific stocks, some speculative portion of your portfolio, you know, whatever. But when it's all said and done, you know, probably trusting the markets is better than, you know, trying to derive some, you know, independent theory and outperform them. Because sure, you could outperform them. You could pull a Cathie Wood. You can just go all in on Tesla and Bitcoin and speculative stocks and outperform them for a little while. But what happens eventually? And then you start looking at like hedge funds and look at like their performance rate over, you know, a 2-year period. And you're like, oh, okay, they beat over 2 years. That's not bad. And then over 5 years, it's like, oh, only about 20% of them beat. I'm making up these numbers right now. I don't know off the top of my head. And then you're like, oh, over a 10-year period, only like 5% beat. Over a 20-year period, only 2% beat. And like, you know, on a long enough time frame over, you know, 25, 50, whatever years, the amount of hedge funds that have actually outperformed the broad market is like, I mean, it's almost zero. So if a hedge fund can't beat the market, you're going to just start from scratch and beat the market? No, just do it the easy way. But again, like always, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. All right, so we made it 1:33. That's cool. I want it to be between basically an hour and 2. I think going 1 hour is pretty unrealistic. But you know, 2 is legit. Hour and a half is perfect. So let me jump back in the chat. Hey, appreciate you engaging today, Logan. Hopefully you are doing well. He says, hang on. Write it up. Low coming. Thanks, bro. Tesla should touch average and dump. So above, so below. Tesla should touch average and dump. I'm assuming that you're talking about the 200 moving averages, but it's already doing that. I mean, it already is above the 200 exponential and the 200 simple. So I don't know if you mean it's going to come back up here and then roll over. I mean, we don't know what it's going to do. It already rolled over. This is a back test and then it probably goes lower. I mean, that's my base case. But also we have a split coming up again soon. So what do we know happens before a split? Well, typically we run up. So, you know, it's not crazy to think that Tesla splits from 900 to 300 and then all of a sudden runs back up to 500. I don't think that's crazy. Now, that's not my base case or whatever, but if you told me 6 months from now that that's what happened, I wouldn't be surprised. So I just right now with an impending split and Tesla doing pretty well, I wouldn't get overly bearish on Tesla right now. Now, obviously, Elon Musk doesn't feel that way since he's dumping billions of dollars of Tesla all over people's faces and telling them he's not going to sell anymore. And then I mean, but can you blame the guy? Like, he's just trying to lock in some of those gains before the big dump, you know. But anyway, yeah, I think we're going to go ahead and wrap it up there. So we did a little something different today, kind of give like a overall breakdown, thesis, theory, like, alternate method, and just talk a little bit about portfolio construction and, the overall relationship of these different assets to each other. And, essentially, I'm not trying to dog on crypto. You guys, I love crypto. This channel is called Crypto Trend Trader for a reason. I think crypto is the future, blockchain is the future, but it's undeniable that when we take that crypto chart and we compare that to, pretty much everything but the most speculative of assets. All 11 sectors of the S&P, with the exception of communication, are substantially better looking. Communication basically looks exactly the same as crypto. So buying crypto now is basically the equivalent of buying the worst sector of the, stock market. Now, that's a general statement, but it's true based on the posture of it. Now, if you bought crypto right now and it goes to new all-time highs, you will obviously substantially outperform the rest of the stock market because it's so far beaten down. So there is an argument that, obviously you want to buy low, sell high, and the more beat down something is, if it goes back to all-time highs again, the more room there is to the upside. But that's if it goes back to all-time highs. And I don't think that Bitcoin is just going to all of a sudden roll over and never go back to all-time highs again. I don't think Ethereum is going to roll over and never go back to all-time highs again. But in the crypto space, there's probably about, there's like 20,000 cryptos, right? I think I said 2,000 a bunch of times, but I meant 20,000. You know what I mean? There's like 20,000 cryptos right now. And probably 19,000 of them never go to all-time highs again. Never, ever, ever. As where something like the Dow Jones, the S&P, are they going to go back to all-time highs? Probably. Very, very high likelihood. Matter of fact, I would say on a long enough time frame, it's a certainty. But, these speculative cryptos, these speculative Cathie Wood stocks that don't make money, all this stuff, they're great. Buy them when we're in a, quantitative easing environment. Buy them when everything's roaring and ripping to the upside. But we don't buy them now. Bottom fishing is okay sometimes, but not with your whole portfolio or 25% or 50% or whatever. Build a solid core and you will thank yourself in the future. But obviously none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. I'm going to go ahead and wrap it up there. It is 9:38 p.m. Eastern Standard Time on August 14th, 2022. If you enjoyed today's stream, please leave a like. Make sure to subscribe. Comments always help boost the videos. I really appreciate it. But that's it. We're going to go ahead and wrap it up there. Everybody have a wonderful evening. Crypto Trend Trader. And I'm out of here.